HIMS and HERS is a company that I'm often asked to cover, and for those of you who have been following my channel for some time, you would know by now that I've initiated a position in this company last year, somewhere in the $18 to $25 range. Now, since then, in the most recent run-up, I've trimmed about half of my holdings because my original investment had actually doubled. So basically what I did was to take out my original capital and to let the profits ride. However, I'm not done with this investment just yet, because what I did thereafter was to take the cash from the sale and sell cash secured put somewhere in the mid $40 range, hoping to re-enter this position again. And this is largely because I believe HIMS and HERS has the potential to continue dominating the healthcare industry in the years ahead. But as always, potential is a dangerous word, so let's dive in. So let's take this from the top. Now, in the most recent quarter, HIMS and HERS grew their subscriber count to 2.36 million subscribers. This represented a 38% year-over-year growth in subscriber count. Now, and from this 2.36 million subscribers, 1.4 million subscribers are on a personalized treatment, and that means the total percentage of subscribers on a personalized treatment increased from 35% in Q1 of 2024 all the way to 59% in the latest quarter this year. Now, as we have discussed in previous video, this is exactly what makes HIMS and HERS an extremely sticky platform, and this is the moat that they have against bigger companies who are coming into the space purely trying to compete on price. Now, during the earnings calls, HIMS and HERS actually gave further guidance all the way to 2030 in terms of revenue, and when you actually combine that with some of the information that they have given us previously, you will actually see that their 2030 guidance is slightly on the conservative side. So if I remember correctly, in the fourth quarter of 2024, HIMS and HERS actually told us that they actually see themselves getting to 10 million members by 2030. Now, if you combine that with their expectation of generating $6.5 billion in revenue in 2030 and a $1.3 billion of adjusted EBITDA, you would realize the numbers is a little bit of a mismatch and they don't really make sense. Now, let me do some simple math for you to prove that to you. If you take a look at this number over here, this is the monthly online revenue generated per member. This currently stands at $84 per member per month. Now, when you multiply this number by the total number of members on the HIMS platform, you will get a number that is pretty close to their overall revenue, and that is how I have been doing my projections. So if you assume that HIMS and HERS reach 10 million members on their platform by 2030, and you take a look at the trend of the monthly online revenue, I think what you notice is that as they add more and more products onto the platform, it increases their ability to cross-sell to existing members and to drive up the monthly online revenue per member. However, at the same time, as they continue to grow their subscriber count, the new subscribers tend to not use as many products as the older subscribers, and this acts as an anchor on the monthly online revenue. So you basically have two factors pulling this number in either direction. Now, therefore, if you use a very, very conservative estimate of $60 monthly online revenue per subscriber in 2030, considering that number is $84 today, with 10 million members, that gets you to a full year revenue of $7.2 billion. Now, why did I say a $60 estimate of a monthly online revenue is conservative? Because in reality, this $60 number was where they were operating at even before HIMS and HERS included their weight loss segment into their product lineup. Therefore, I do think a $70 monthly online revenue per subscriber is a more realistic target, and using this number, that would result in a full year revenue of $8.4 billion in 2030. And if you want to go a little bit more bullish and you use $80 of online revenue per member, you get a full year revenue of in 2030 of around $9.6 billion. Now, if you consider that their adjusted EBITDA margins is projected to be around 20%, this means adjusted EBITDA will come in anywhere between $1.4 to $2 billion. And for subscriber growth to actually reach that number, 10 million subscribers in 2030, they would have to grow at a 6.5% CAGR quarter over quarter or 30% CAGR year over year. And if you consider where they are right now, I think this is quite a realistic target for the next 5 years. And because they are also growing their members at a very healthy clip as it is today. Now, if you have followed my previous video, I think you would know by now that one of my concerns surrounding HIMS was their spend on marketing, and I had hoped to see this figure actually come down closer to the low 30% range, and we're finally seeing marketing spend as a percentage of overall revenue come in at a percentage that starts with the number 3, right? So marketing spend in Q1 of 2025 came in at around $231 million. This represented 39% of overall revenue. Now, when I calculated my customer acquisition cost, I basically took the the entire marketing spend, divided it by the total number of new members, which is why initially I had some sort of discrepancy with how HIMS calculated the numbers and how I calculated my numbers. But I do believe that HIMS does it by only attributing the cost related to direct marketing material, like all the media material that they use for the Super Bowl and things like that. And why I'm bringing this up is because I realized that the trend is the same whichever way you want to do the calculation. I think in general what we are noticing is an increase in marketing spend on the absolute dollar amount, and management has told us that to expect a ramp in marketing spend every time they are releasing a new product or they're entering a new specialty. And with their release of their GLP-1 products in the back half of last year, that is why we're seeing an increase in marketing spend. We have seen them take out advertisements with the Super Bowl and things like that. And so despite their aggressive marketing spend, they are actually able to keep up in terms of their top line revenue growth. So as of now, this isn't a concern. Now, if you take a look with me at the unit economics, I think one of the big difference from the way I do my calculation of their payback period is how we define the revenue per customer. In fact, over here, you can actually see that they're using the gross profit generated per customer. And I think a large part of this discrepancy has to do with the amount of data that is available to investors compared to what management have. So if you take a look at this graph over here, which is, like I said, one of my favorite graphs in the whole presentation, the cost it takes to acquire a new customer in Q1 of 2024 comes in at around $113. And they are able to make back that marketing spend within 2 quarters, and they are profitable on a per customer basis by the end of the year. And what we are seeing within each cohort is that the spend on a per customer basis increases quarter over quarter. And like I said, this wasn't something that I projected out previously. Now, on top of all of this, I think what you also notice is that in the long term, they tend to have an 85% retention rate, which goes to show that their product is extremely sticky. So when it comes to the latest news around HIMS, I think the most significant one is their partnership with Novo Nordisk, where they are offering Wegovy, a popular weight loss drug, on their telehealth platform at around $599 per month for cash-paying customers. Now, to me, this significantly reduces any risk of a lawsuit from Novo Nordisk, and a similar partnership with Eli Lilly could be on the tables. And so this basically allows them to build out a robust suite of products in the weight loss category that complements their own oral weight loss medication without having to take on this additional risk of potential lawsuits in the future. And for me, I think that removes a huge bear case against HIMS. Now, earlier on in May, I think HIMS also announced the $450 convertible note deal. This deal basically is going to fund expansion into the global arena, and at the same time to help them to continue to improve their AI and tech infrastructure and enhance personalized healthcare solutions. You see, moving forward in 2025 and beyond, HIMS is focusing on scaling their operations and improving its tech infrastructure to allow it to accelerate penetration into various markets, into new specialties, things like hormonal therapies. And I believe these will open up huge opportunities for them going into the future. Now, with all of this in mind, let's tie everything together by looking at the valuation. Now, on a trailing 12 months basis, if you consider their Q1 2025 revenue of $586 million, you get a trailing 12 months revenue of $1.78 billion. Now, this works out to be around $7.97 of revenue per share. And if you take a look at the average price to sales ratio for companies in the similar healthcare industry, companies like TMDX, like Novo Nordisk and Eli Lilly, you basically get an average price to sales ratio of around 9 times. Now, if you apply a 9 times price to sales, then you get a fair value of HIMS on a price to sales basis at around $71.75. Now, if you are using the PE ratio, their net income on a trailing 12 months basis comes in at around $164 million, which puts their EPS at around 73 cents. Now, if you are using 70 times PE, which is slightly lower than where they are today, HIMS really should be trading at around $51.10. Now, if you take the average of these two prices, you get a fair value closer to $61.40. However, because HIMS is such a volatile company, I feel safer with a 20% margin of safety. And therefore, if you apply that 20% margin of safety, you get a fair value of HIMS closer to $49.14, which represents more or less where we are today. Now, for a fun thought experiment, because I did this with SoFi, let's project out the 2030 expectations for HIMS. Now, this is a little bit more of a high-level projection compared to my SoFi video, and I will be spending time over the next couple of weeks to see if I can dig a little bit deeper into our assumptions. But if you take what management has told us, right, they want to achieve 10 million members or 10 million subscribers by 2030, and the online revenue comes in at around $70 of monthly online revenue per member. This puts their total revenue in 2030 at around $8.4 billion. Now, I'm totally discounting the wholesale portion of their revenue over here when I'm doing this calculation, and I'm also assuming a 4% dilution every single year. Now with that gets you to around $31.27 of revenue per share by 2030. Now considering how Eli Lilly and Novo Nordisk, despite being mature companies, are trading at 6 to 13 times price to sales, I would expect HIMS to do the same, right? So therefore, going into 2030, I'm still going to be using the same price to sales ratio as we did previously, which means a 9 times price to sales. And so if you apply a 9 times price to sales, what you get is a fair value of HIMS using the price to sales ratio at $281.46. However, for our more conservative friends who wants to use 6 times price to sales, that is fine as well. That is even lower than where we are today, and that puts the price targets for him at 2030 at around $187.64. Now, if you take the average of these two pricing using the various price to sales ratio, you get a price target of around $234.55 by 2030. Now, that represents a 32% CAGR from where we are today, and to me, that is more than decent returns. Now, if you go one step further and do it on a PE ratio basis, I think the assumption here is that the net income should come in closer to 15%, right? The reason why I'm saying that is because the adjusted EBITDA margin is projected to come in around 20%. And if you consider that, margins in the most recent quarter came in at 8.5%, I think 15% over the course of 5 years is definitely doable. Now, if I'm using the same dilution assumption, that would put their 2030 earnings per share at around $5.63. Alright, I want to very quickly explain what's happening over here. In the Excel file, basically when I took the net income divided by the total number of shares outstanding, I used the original number of shares outstanding instead of the diluted number. And so because of that, the earnings per share came in at $5.63. And what you're seeing over here is me actually changing it post-production to the correct earnings per share after you accounted for the dilution. So that makes the earnings per share in 2030 at $4.69. And because of that, at the end of the day, the average price target taken will be slightly different from what you're hearing me say, but the slides are actually correct in the rest of the video. Now, currently, Novo Nordisk is trading at a PE of somewhere in the 20s, and Eli Lilly is trading at around 58 times PE. But the reason why Novo Nordisk is so cheap is because of certain headwinds that they are facing. Therefore, I feel comfortable using a 40 times PE in 2030, because by then, the growth for HIMS and HERS would definitely have slowed down, but they should be still growing faster than some of these more mature companies. So at a 40 times PE, that gets you to a price target of $225.17. And from here, what I've done is to find the average price target by using the 9 times price to sales number as well as the 40 times PE number. Now, this gets me to an average price target of $253.32 in 2030. Now, this represents a 34% CAGR from where we are today. And there is another company that can put up similar growth numbers over the next 5 years, and I talk more about them in this video over here, and I will see you in the next one.